When you think of careers in finance, the first things that probably come to mind are investment banking, private equity, hedge funds, those sorts of things. But in truth, finance is such a large field and there's so many different avenues that you can take depending on your skills and your interests. So in today's video, I'll be going through what I personally think is a role that sort of goes under the radar when people talk about finance careers, but one that can still be intellectually and financially rewarding and offers a great balance between work and your personal life. The role I'm talking about is the financial risk manager, and is the role that I've been lucky enough to get straight out of college and have been working in for the past 3 years. Now, I did make a video on what a risk analyst does in the past, which I highly suggest you check out after this video. But since making that video, I've worked almost a year at a hedge fund, so I'll be able to give you guys insights on what the role is like both at a bulge bracket bank like JP Morgan and also at a hedge fund. And in this video, I'll also be breaking down in a more clear-cut fashion exactly what the pros and cons are of this role so that you can better determine if this role will be something you'd be interested in or if it's a good fit for you. And to clarify, today I'll be talking about risk management as it pertains to the financial markets and managing the risks of traders, whether it's at a bank or at a hedge fund. Starting off with the pros, the work-life balance you get working in risk management is probably one of the biggest positives. When I first started working at JP Morgan right out of college, I used to get to the office at 7 a.m. because I had to get on a call with the traders and take notes for our MD. I would also leave the office around 6 p.m. because I had to send an end-of-day email that summarized our risk and P&L, and that data was only available after a certain time. However, this was when I first started out as an analyst and I wanted to contribute as much as possible. But as time progressed, I started to split these responsibilities with my teammates, and then my days started looking more like 8 to 6 or 8 to 5, so more so around that 50-hour mark, but really no more than that. I never had to work late at night or on weekends, but I will offer a caveat to this by saying that I did cover municipals, which is a much smaller market compared to, say, the equity market or the bond market. So for example, when Russia first invaded Ukraine back in February of 2022, a lot of my colleagues working in those departments had to put in some long hours, some late nights to finish some deliverables for senior management, while I basically saw no change to my schedule. But essentially, depending on the market you cover, during crisis periods, your hours might be longer given you are the risk team after all. On the hedge fund side, my hours are pretty similar. I'm also putting in about 50-hour weeks and was never required to work at nights or on weekends, but again, that can potentially change during periods of extreme volatility in the markets. The second pro is that risk management is not really a stressful job, relatively. And I say relatively because most finance jobs can be quite stressful, especially when billions of dollars are on the line, you're working long hours, or there are a slew of deadlines to hit. But compared to, say, traders who are actually making the trades and taking on that P&L risk and subsequently putting their jobs on the line, risk management is a lot less stressful. Instead of going home at night worried about what might happen in the markets overnight or the very next day that might negatively impact your portfolio and potentially cost you your job, I can go home and sleep soundly knowing that my job won't necessarily be on the line if the market moves adversely. This brings me to the next positive, which is that risk managers tend to have good job security. If you're actually conducting trades, your job is largely dependent on, surprise, surprise, your ability to make money. After all, this is the finance industry. But given how markets are extremely unpredictable, if you're not properly managing a risk, one mistake could cause you to fall below your P&L limits, and the next thing you know, you'll be dusting off your resume. Now, this is a problem I mostly observed with hedge funds since strict banking regulations usually force traders at big banks to hedge out their directional market risk, which means they won't be as severely impacted whether the market goes up or down.
Harper, don't f*** around. Cover that risk now.
But the point still stands that risk management is not a job where either you perform and make money or get replaced. Obviously, there are other ways to judge the value and performance of a risk analyst, but making trades is not one of them. Not to mention, risk management roles do tend to stay pretty resilient in all stages of the economic cycle. During boom periods when the economy is doing well, banks might want to hire more traders to increase their revenue. But as soon as the economy turns sour and companies need to start cutting expenses fast, these roles that were added during the expansionary period would likely be the first to go. Whereas risk management functions tend to be the last to go if a bank is looking to downsize their headcount. The fourth positive is that risk management can offer some pretty good career exit opportunities if you're looking to change things up. There are a few common trajectories, the first being naturally rising through the ranks and becoming a managing director at a bank or a senior risk manager at a hedge fund. And if you really stick with it for the long run, you can become the chief risk officer of an organization. The second most common that I've seen is transitioning to a trading role. As a risk manager, you will learn a lot about the market or markets that you're covering, such as what drives that market, what products are traded in that market, what are the risk metrics associated with it, and much much more. And because you develop this knowledge base surrounding a particular market, you become a natural choice for trading desks if they're looking to expand their team, especially when the job market is tight and talent is harder to come by. These two paths are generally the most common I've seen, but I've also seen risk analysts transition to other parts of finance, such as investment banking, asset management, or even going back to school to get their MBA or master's degree at a top business school. The bottom line is that risk management is a career path that teaches you about many aspects of finance and markets while developing both qualitative and quantitative skills, which will prepare you well for a number of opportunities both in and outside of finance. Speaking of skills, I would say that risk management does not have a terribly high educational barrier to entry. In fact, most of the skills I have now, whether it be coding in Python or using Excel or knowledge about the financial markets, have been accumulated while I was on the job. And prior to receiving my job, I only had 2 internships, which didn't give me a whole lot of hands-on experience, and I took a few finance courses as part of my finance major in college. To get a role in this field, I think all you really need is a bachelor's degree, preferably in a major like finance or economics, or in something quantitative like math or statistics. I will say though that there are certain parts of risk management, especially when you start getting into financial risk modeling, where you need some sort of quantitative degree like financial engineering. Or if you want to cover a certain group like exotic derivative products for rates or equity trading teams, a quantitative graduate degree can definitely help your chances, if not being an outright requirement for the job. The last positive I want to talk about is the work itself, and generally speaking, it can be pretty interesting. At a bank, you have a few main responsibilities. The first is to analyze your trading department's risks using a number of different risk measures and tools, but mainly VAR, stress tests, and the Greeks, such as Delta, Gamma, Vega, etc. To briefly explain what those 2 tests I just mentioned are, VAR stands for value at risk and basically tells you your tail risk or how much money you stand to lose given a very rare market move. For example, say you have a $100 million portfolio and your 95 percentile VAR is 2%. That stat is essentially saying, according to the model, you can expect your portfolio to lose $2 million about 5% of the time. You can change certain parameters to your preference, such as the confidence level, aka the probability in which you expect a certain loss. You can also choose to use historical data for your VAR tests or use a Monte Carlo simulation to determine your VAR for potential future values of your portfolio. Point is, there are many different types of VAR tests and different firms will elect to use different tests depending on what they want to monitor. As for stress tests, these are tests that show how much you stand to lose given a specified move in a certain market. As a simple example, if you have a stress test of the S&P 500 going down 10%, it will show you how your portfolio is expected to react to the move given the correlations between different assets. For example, if you have Apple stock in your portfolio, that might move a lot given a 10% move in the S&P 500, but a less correlated asset like gold will likely not move as much. Now, this can be very interesting because this is a side of the business that traders don't necessarily get to see. Traders can only see their own positions, but the risk team are able to see a top-down view of everything that's going on, from trades being made to P&L to risk. In addition to analyzing risks, some of the more interesting work involves doing research. An example of this was when I was covering municipals at JP Morgan, and I was tasked to do some research on a very specific type of municipal bond, one that my team was not very familiar with, and analyze the potential risks behind it. In my current role, one of my research-focused tasks have been to try to come up with better stress tests to more accurately model curve shifts in the US Treasury market. Now, everything I just mentioned are some of the more interesting parts of the job, but there are certainly some less exciting parts as well, which I will get to in the negatives list. Also, given all this, I will offer a caveat, and that is, it depends on what risk management function and what type of institution you work for. Risk management is still quite a broad term, and there are functions within the risk department that I would personally consider less interesting. When I was working on the sell side at a bank, I was within a function called market risk, and as the name suggests, you cover the market risk of a certain asset class and are in charge with doing more of the active analysis and monitoring of the risk. But there were other teams that we worked with that were in charge of tasks that were less related to the markets, such as publishing reports to send to the Fed, checking over regulatory documents and spreadsheets, and things of that nature. Essentially, risk management can be a broad term at a big bank, so it's important to go into the details to determine exactly what part of the risk function it is that you're signing up for. While risk management at a bank did have its moments, I currently prefer my role working at a hedge fund much more because I think the work is a lot more interesting and rewarding. I find myself doing virtually no regulatory work, which is quite a boring part of my previous job. I'm doing a lot more market-related research and analysis, and I'm also learning how to code and develop tools that can be directly useful to my team. I actually go into some more detail regarding the differences between these two roles in this video, so go check that out after this video if you're curious about that. Okay, now that we've gone through the positives, it's time to talk about some of the parts of this job that I wasn't too thrilled about. As I mentioned before, a big downside was that there were big parts of the job that were less exciting. For me, that was mainly doing regulatory work and dealing with tech issues. As for the former, at a large bank, the risk department is in charge of working with the regulators to make sure that the bank isn't taking on too much risk. And one thing we had to do quarterly was something called CCAR, or Comprehensive Capital Analysis and Review, which was essentially a quarterly exercise in which the entire risk department had to compile a bunch of data to then send to the Fed, which they reviewed in order to basically make sure that the banks had enough capital to sustain losses under a number of different extreme market moves. Essentially, this involved collecting a bunch of data and compiling it into a pretty complex template. Now, that might not sound like it would take that long, but when you have a portfolio consisting of hundreds of different bonds, options, credit derivative products, it can be very time consuming to compile all that information. As for dealing with tech issues, this also was a part of the job that I wasn't particularly fond of. Essentially, ever so often when we're going through our daily processes, we might find some risk numbers that don't quite look right, in which case we'd have to go in and investigate and try to figure out the issue. Now, sometimes it could be as simple as the data not being sent through on time or something like that, but other times there would be an issue with the underlying risk model that is calculating the risk statistic. In these cases, we'd have to reach out to our risk quant teams to fix the model, then rerun the data and see if that fixes the issue. And this consisted of a lot of back and forth comparisons with spreadsheets, slicing the data in a bunch of different ways, which all around wasn't very interesting, but it had to be done. The second biggest drawback is the pay, and it really only is a downside depending on how you look at it. Now, obviously, since the risk department isn't a revenue generating part of the business, as in directly bringing in clients or making trades, the compensation isn't going to be as high as a role like trading or sales. Now, on the flip side, your hours will be better and you won't be as stressed, so there is that trade-off to keep in mind. For a bank, the main difference in compensation lies in the bonus. In the year and a half that I worked at a bank, the salaries across the trading floor were pretty much equal, from the salespeople to the traders to the risk team. But while traders could potentially earn somewhere from 50 to 100% of their base salary in bonus, the numbers I saw for the risk team were more around 25 to 50%. Now, these numbers will tend to fluctuate a lot depending on personal performance and the economic environment. I have heard of some years where trading desks paid out much lower bonuses than the percentages I mentioned, but in those cases, the risk team will probably be even lower. At a hedge fund, compensation is treated a bit differently and is much more closely linked to personal performance and the performance of the fund. So while salaries may not be as big as the banks, bonuses are typically larger. Ultimately, while some may view the lower overall compensation as a negative, others might value the extra free time and the less stressful lifestyle, so it all comes down to personal preference. At least for me, I know one thing, which is if I worked those 100-hour weeks as a banker, I certainly wouldn't be able to film and edit these videos. This next one is also sort of a neutral factor, but I chose to put it on the cons list because I personally saw it as a con, and that is you really are limited on where you can live if you decide to go into this field. And by limited, I mean you'll most likely be living in New York City or another major city. Now, there are financial hubs in Chicago, San Francisco, Miami, or if you go internationally, London, Hong Kong, etc. But essentially, you'll most likely be living in a high cost of living metropolitan area, which isn't the ideal lifestyle for everyone. In my first year of working, I tried my best to not have to live inside of New York City and instead opted to live in a small town in Connecticut. But after a whole year of waking up at 5 a.m., taking a 1.5-hour train, and then getting back home at 8 p.m., I had finally had enough and decided to move into the city. Only when I got there, I realized that a $120,000 salary really doesn't go that far in New York City. So location can definitely be a major downside, especially if you're trying to save money or don't particularly like city life, because when it comes to jobs in the finance industry, your options can be quite limited. This last negative, which probably is something that you haven't thought about, is that there does tend to be a perpetual tension between the traders and the risk team, where the former group are incentivized to generate as much revenue as possible without thinking too much of the tail risks, while the risk team only focuses on what potential risk the trading business can expose themselves to and prevent that from getting out of control. This is by design. After all, you do need some healthy tension and discourse in order to maximize revenue while also not taking on risks that could risk destroying the whole business. But the key word is healthy, and it varies team by team, bank by bank, but sometimes there can be situations where traders want to conduct a trade that the risk team deems to be too risky, and that can result in a disagreement. I've even heard stories from more senior risk managers that fights have almost broken out on the trading floor because of these very reasons. Essentially, some desks can have better relationships between the traders and the risk managers managers, and some desks can have worse relationships. Luckily for me, when I was covering municipals, the two heads of the department were very good traders, they paid a lot of attention to risk, and as a result, we had a very good relationship. The traders in our team would go out to a baseball game once in a while. During the holidays, some of the senior department heads would take us out to a nice lunch to a steakhouse somewhere, and I was just very appreciative of this culture of collaboration rather than antagonism. And this is all something that I've seen more so working at a bank than at a hedge fund, and again, these bad relationships between these two functions don't happen terribly often, but it is possible. So in conclusion, like any other job, the role of the financial risk manager has both its positives and its negatives, and it really comes down to what you're looking for out of your career and your life. Ultimately, I think risk management is a good choice for anyone that enjoys and is interested in working in the financial markets, likes to dive deep into certain markets and quantitative concepts, but also wants a good work-life balance and a low-stress lifestyle. Now, I'm not saying that I'm in this role for specifically those reasons, but I certainly am grateful to have started my career in this field, and I've learned a tremendous amount that I'm sure I will take with me for the rest of my career. If you guys have any further questions, please do leave them down in the comments below. I'll try to answer them the best I can, or I'll address them in a future video. And as always, take care. I'll see you guys in the next one.